Before we continue on to the item sets, what I'd like to do is I just want to complete this little section, as I just said, about LOS 46D, which wants you to explain how capital market expectations and the investment policy statement help influence the strategic. Again, what does strategic mean? Long term. Anytime you see the word strategic, it means long term. Tactical means short term. So strategic asset allocation would be the long-term asset allocation. Tactical asset allocation would be any kind of short-term deviations that we're going to make to the strategic asset allocation decision, and how an investor's investment time horizon may influence the investor's strategic asset allocation. Okay, there are three common approaches to strategic asset allocation. There's three common approaches. 1, 2, 3 that you want to put on your own index card or your own notes. One of them are passive investment strategies. The other one is the opposite spectrum, active investment strategies. And then the third one would be what we call semi-active or risk-controlled or enhanced indexing strategies. Now, I want to explain the three of those, and then we're going to go do this item set. With passive investment strategies would be any type of strategies that are taken where there's going to be little or no active management, meaning that you're really trying to create a portfolio that is, for example, going to mimic the performance of an index. That would be a passive strategy. Okay? Passive strategies would be where you're not going to have to pay these active management fees to the portfolio manager for his stock picking capabilities. So again, these passive strategies represent strategies that are not going to be responsive to any kind of changes in expectations. As I just said, an indexing strategy, buying a S&P 500 index fund, that's a passive strategy. Any kind of buy and hold investment strategies are also considered to be passive in nature. So that's what we mean by passive strategies. Now, what you're trying to do with passive strategies is you're trying to not only replicate the performance of the index, you're also trying to maintain the same level of risk in your portfolio as in the actual index. Why? Because you cannot actually purchase the index. You can't go out and say, I want to buy the S&P. What you need to do is you need to buy the shares of a fund, for example, that are going to buy the securities of the index to create an index fund. So there's no, and you'll actually see this a lot of time with advertisements for the S&P 500, you'll see, or the whatever, Russell 3000 or Russell 1000 is that this is the indice's performance, okay? And basically an index is not investable. You can't invest directly in the index. You have to create a portfolio that's going to mimic that index. And so there's going to obviously be, hopefully your returns will be just in line with the index. It might detract a little, might even be a little better, but sometimes worse based on other types of things like any kind of management fees or any kind of marketing costs or any kind of other tracking issues, which we'll talk about later. So those are what we call passive investment strategies. Now, active investment strategies, which is on the complete opposite side of the fence of passive strategies, those are, if you will, going to be more responsive to any kind of changes in expectations. Here, what the portfolio manager is trying to do is they're trying to capitalize or take advantage or exploit any kind of differences between what the marketplace is doing or thinking and what they are thinking. So obviously taking advantage of either undervalued sectors, industries, or specific securities and rotating them or buying specific securities. And then if they believe something is out of favor or overvalued, they might want to sell those sectors or de-emphasize them, or industries or specific securities. And what they're trying to do here is they're trying to generate alpha. So generating alpha, for example, and investing in a particular style, such as growth or value, those all are going to fall into this category called active investment strategies. Now, so you have the passive on one side, active on the other. In between is what we call semi-active, risk-controlled, or enhanced indexing strategies. Now, what does that basically mean? An enhanced indexing strategy, you've probably heard that term before. An enhanced indexing strategy means that we're going to maintain the same level of risk as a particular benchmark. And a benchmark in many cases can be an index. Okay, a benchmark doesn't have to always be just an index. But we're going to try to maintain the same level of risk as a benchmark. So technically we should get what? The same return as the benchmark? No. What we're going to do is we're going to maintain the same level of risk as the benchmark, but we're going to try to outperform the benchmark or outperform the index. That is called an enhanced indexing strategy. We're going to control the portfolio in terms of the same level of risk as the benchmark, but we're going to outperform it. And how are we going to outperform it? Based on the securities that we selected, or the sectors that we emphasized, or the industries that we emphasized. We're going to try to outperform the index, but with the same level of risk. Now, how is an enhanced indexing strategy undertaken? This can be done with bonds, and this can be also done with stocks. What we're going to do is we're going to take an index. This is how it works. Now, this is not explained in the readings, but it's very helpful to you because then you'll learn about it even more in depth in level 3 when you do the fixed income portfolio management and the equity portfolio management. What we're going to do is we're going to take an index, let's say like the S&P 500. Let's say we don't want to buy all the stocks that make up the S&P 500. You know why? Because if we bought one share of each, that doesn't make any sense. So we'd have 500 shares. But we wouldn't be able to earn much of a return or much of a profit. So what we need to do is we need to buy shares, okay, of securities that are in the S&P 500, okay? Because we want to have the same level of risk as the S&P 500 in my example, but we want to outperform it. So what we're going to do is, one thing we could do is we could just say, you know what, we're going to do a passive investment. We're just going to buy all the 500 shares that make up the S&P 500. We're going to have it in our portfolio, and the performance of our portfolio would equal the performance of the index, of the S&P 500, more or less. That's a very passive strategy. We don't want that. And not only that, we have to commit a lot of money there because we have to have every stock that's in the index in our portfolio, all 500. A different way to achieve hopefully success is to say, you know what, the S&P 500 is 500 different stocks. I don't need to own 500 stocks to create a well-diversified portfolio. You know what I'm going to do? I am going to take that index and I'm going to make sure that we have the same level of risk as the S&P 500 index, but then we're going to actually outperform the S&P 500. We're going to do this enhanced indexing strategy. So how do we undertake this? Well, what we're going to do is we're going to use a process called cell matching or stratified sampling. Cell matching. What we're going to do is we're going to take the index, okay, and then what we're going to do is we're going to take specific risk factors. We're going to identify specific risk factors. And this is the stuff that they later on gel in the level 2 readings and then later on in level 3. We're going to specify specific risk factors like PE, earnings, value, growth, quality, whatever we want. We can determine what the risk factors are. And we're going to select certain risk factors, and then we're going to take every security that's in the S&P 500, and we're going to put it into those cells based on the risk factors. Now, the more risk factors that we use, the more cells we create, the more likely our portfolio is going to be very similar to the actual index. The fewer the cells that we use or the fewer the risk factors that we use, the more of a deviation we can have from the performance of the index. So we're going to identify those risk factors, for example, that I just mentioned. And then once we create these risk factors and cells, we're going to take each security that's actually in the index and we're going to put it into one of those cells. Let's say we have 10 cells. Okay? And then what we're going to do is we're going to calculate the market value of each cell. By doing what? Taking each security. How do we come up with the market value of each cell? We're going to take the market capitalization of each security that's in the cell. So in cell 1, let's say cell 1 is made up of 10 securities. We're going to take each security's number of shares of outstanding, usually the free float, times the market price of those shares, and that's going to give us the total market cap or the total market value of that share. So then we're going to add up the total market value for cell number 1, cell number 2, all the way through cell number 10. If we add up the total market value, the total market capitalization of cells 1 through 10, we will have the total value or the total market capitalization of the index. And let's say the total market value of the index is $100 million. And cell number 1 has a value of $1 million. Then if I take the total market value of cell 1 and I divide it by the total market value of the index, again, market capitalization or market value, whatever you want to call it. If I take the total market value, the total market capitalization of cell 1, and I relate it to the total market capitalization or the total market value of the index, that would give me the weight of the first cell. So I would come up with the weight for cell number 1, cell number 2, cell number 3, cell number 4, cell number 5, and then those weights for each of the cells that make up the index would be the same weights for my portfolio. So when I create my portfolio, cell number 1 would also have a weight of 10%. Cell number 2 would have the same weight as the index, and so on and so forth. What's the difference? The difference is when I do an enhanced indexing strategy, I am only going to select certain securities that are in the index most of the time to represent each cell. So I don't need to own all of the different stocks that are in the index like I do with a passive strategy, such as an index fund. I'm going to say, well, you know what? I don't think that I should have all of the stocks that are in the S&P 500 in my portfolio. So I am going to include certain stocks in cell 1, cell 2, cell 3, so that the market value weights of cell 1 match the market value weights of cell 1 in the index, and so on and so forth. So I will have the same level of risk as the index, but I will have fewer securities. And if I select those securities correctly to represent each of the cells, and those securities actually outperform or do very well, and then sometimes I could also include other securities that are not in the index, I will still have the same level of risk as the index, but with fewer securities and hopefully a higher return, because I will identify those securities that I believe are undervalued and will outperform or go up, and I've weighted them accordingly. So I should be able to outperform the index with the same level of risk. That is what we call stratified sampling, or this cell matching strategy. And that is a semi-active enhanced indexing strategy. So that is what enhanced indexing is all about, is having the same level of risk, but with fewer securities than the index, and outperforming the index with fewer securities. That is what we call a semi-active, risk-controlled enhanced indexing strategy.